Good afternoon, everyone, and welcome to the Real Vision Daily Briefing. I'm Andreas Steno, sending to you live from Copenhagen, Denmark. Today it's Thursday, the 23rd of June, and we have a very interesting macro backdrop to discuss today. And with me today is Weston Nakamura, the global markets editor from Real Vision in Tokyo. Weston, very warm welcome to the show.
Thanks a lot. Great to be on with you.
It is. I mean, what a macro backdrop to have on a day like this. We've had basically a landslide in European interest rates on the back of disappointing PMIs out of Europe. But otherwise, I'm basically curious whether the market is slowly but surely changing its narrative towards a growth scare instead of an inflation scare. Let's start with that million-dollar question, Weston. What do you make of that question?
I think that's probably been underway for last few weeks and starting to pick up steam. I think that still, though, by and large, it's still mostly an inflation scare thing, simply because of the fact that, as we saw with Chairman Powell for his second day in front of the House this time, but it's just the Fed is just inflation, and so are the rest of the central banks, global central banks, with the exception of one central bank. But so I think that they're going to express concern about recession, about growth slowdown, but they really need to get inflation under control. But that's just my, sort of view. What's your view on that tilt?
Well, I think it's interesting that we've seen cracks appearing in the commodity space. We've seen oil prices retracing from highs. We've seen the copper price retracing from highs, etc. Right? We've seen the first signs of the cycle turning against us in the commodity space. And what I find really interesting is that we have this very close relationship between inflation expectations and commodity prices overall across the globe. And that's one thing that could eventually lead to some kind of topic within the central banks, that commodities have started to turn. What do you make of the pricing in commodity space that we've seen recently?
So I'm just gonna lay this out. Markets are extremely confusing right now to me. It's like everything that I am, kind of accustomed to. I mean, I'm always kind of very much on my toes. I'm always trying to question my own sort of thesis. I'm trying to, on a daily basis almost, just to try to reprove if I'm in the right direction or not. But really, since the SNB, the Swiss National Bank, when they suddenly hiked rates last week, that is when things just really fell apart. I mean, even basic things like dollar yen and 10-year U.S. Treasury yields, and just basic yield spreads between nominal yield spreads between U.S. and Japan, all that kind of thing. Like that, they have nothing to do with one another anymore. With regards to commodities, copper. When I think of copper, I think of USD CNH. That correlation has broken down as well. So I'm very lost. So I'm hoping you can have some sort of answers to me, especially with copper.
I mean, Weston, I've been banging the drum for quite a while that if you look at the credit cycle, so the amount of credit available to the private sector across the globe, we've seen a material slowdown in that metric over the past 2-3 quarters in a row. And to me, that's usually the typical harbinger before you see a slowdown in the commodity pricing. And the reason is that credit is a leading indicator of growth. And we've had the PMIs out today from the euro area, but also from the market in the USA, basically pointing south. No surprise to me, but apparently a surprise to the market given what we've seen in interest rate space, in particular in Europe. But to me, it is the first sign that the cycle is clearly rolling over on growth. And I think that will turn into a topic for central banks eventually during the second half of the year. The tricky thing here is timing, right? Because they have high inflation and a growth cycle that is clearly weakening. What do you make of that cocktail, basically high inflation and slowing growth? It's tricky to maneuver as a central bank, right?
Yeah, it certainly is. I am of the, I guess in the Jim Bianco camp, in which, I mean, at the end of the day, well, as far as the Fed is concerned, this is, they do have the dual mandate, and growth is not one of those two mandates. So U.S. is already certainly at full employment. And so they have one job, and that is to tackle inflation. And if that means that they need to break things, then they're going to have to break things, because it's not their job, despite the last decade or so of artificial intervention and QE and so on and so forth. It is not their job to support asset markets. It's their job to, maintain price stability. And clearly we are not. I think that, again, it tilts more towards that way. But I want to actually ask you about, especially like Europe today it seemed to just horrendous with especially German PMIs, and you had some thoughts about manufacturing PMIs, but services PMIs. Can you elaborate on that a little bit?
Well, basically, I think it's a done deal that manufacturing PMIs will look horrendous over the next couple of quarters. That's basically just a lagged effect of interest rates rising. We know that manufacturing PMIs are very sensitive to interest rates. So when we see interest rates rising in the way we've seen over the past couple of quarters, it will eventually lead to very, very negative manufacturing PMIs. But until now, we've sort of cling to the straw that the service PMI would stay positive due to the reopening effects on the economy, tourism booming, traveling booming, etc. But the first sign today from the German PMI was basically that the service sector is also underwater, which is a game changer to me. And I think that's why we have this very fierce reaction in interest rate space in Europe. We've had a double-digit move in 10-year Euro swaps as a consequence of this PMI figure. And I think it's a fair move given what we've seen from these PMIs, because if both services and the manufacturing part of the PMIs are moving down, then it eventually means that the GDP number will look very bad. So the ECB is now basically stuck between a rock and a hard place, because inflation is still running hot, but growth is looking exceptionally lackluster already. And that's a tricky thing to maneuver, because especially within the euro area, what do you do when inflation is hot and growth is not?
Right.
When you have a couple of countries within the euro area dependent on very low interest rates, it's not an easy decision, right? I mean, I'm happy that I'm not on the board of the European Central Bank over this summer, because I mean it will be an extremely tricky decision. I want to ask you a question on another central bank currently also being discussed across the macro landscape, and that's the Bank of Japan. I know that you've been following this central bank very fiercely, and we've had a lot of debate ongoing on whether they will need to increase the ceiling on the yield curve control in the 10-year point. What's your take on that? Is it a feasible scenario at all?
Of course it's feasible. I mean, it's certainly feasible. The question is, how and when. But they cannot, they can't cap 25 basis points forever in a rising yield environment. When you're getting last week you had a record amount of fixed rate operation, and JGB buying from the Bank of Japan, matched with foreigners record net selling JGBs to the Bank of Japan, and you saw insane volatility in JGBs as well. I think that they were dating back to maybe even above the March 2020 levels, but the way that I see my kind of overall takeaway from BOJ not having changed the 25 basis point band on yield curve control, and thereby, I guess a few widows were made that day to add to the large graveyard of widows. But basically, so Japan, when it comes to currency versus the yen versus JGBs, they have to save one to burn the other. So currently they're supporting the JGB market, and they're going to burn the yen in order to do so. And I think that this question of FX intervention, that is not coming that's very far away. And I don't mean by in terms of time. I'm measuring that in terms of circumstance. And so it's not a certain level. There's a lot of people who say 135, 140, 150. It's not a certain level that's going to be some line in the sand. It's the velocity and the volatility in which it gets to that level. But the way that I see it is you have less than 1 year left for this gentleman, Mr. Kuroda, as the longest running Bank of Japan governor in history. And at that point, you're probably going to get a major policy shift. But before then, as of yesterday, we had the upper house election campaign season start, and that's coming in early July. And then depending on how that goes, that's going to maybe influence who is going to take the helm at the BOJ. Until then, though, the message I'm getting is just very clear. The yen can go to hell. The Bank of Japan is going to cap 25 basis points, or they're going to defend the JGB market above and beyond anything else. And even if that means dollar yen at 140, 150, the alternative is that you have borrowing costs spike, and more so than that, if the Bank of Japan essentially is perceived to be giving into market forces, foreigners selling, shorting, futures, JGB futures, and if that's what can basically drive the central bank policy, then the central bank has no more policy credibility ammo left. And, BOJ can do whatever it is that they want to do, and they don't really care about foreigners that much. But now it's the reason it's different this time is because for the first time since Abenomics, really, people on the ground in Japan are feeling inflation, and they're pissed off, and they are going to express that view at the ballot box. And you're starting to now get Japan to join the rest of the Western, democratic capitalist nations in the non-independence of central banks and the politicization of central banks. But that's basically my view. Kuroda is basically, he's planted his flag down. The more that the foreigners push on the JGBs, the more firm he has to be. And so it's just going to be this reinforcing sort of thing. He cannot give in at any point. So that's. But what are your thoughts? I know that you're closely watching it too.
Well, I'm tempted to take the opposite side of this bet, basically because it is very tricky to defend an easy monetary policy stance as soon as the inflation is running above target. And in that regards, we have an inflation report out tomorrow, as far as I'm concerned, in Japan, right, the 24th of June. And
a few hours, yeah.
yeah, exactly. Yeah, I mean, just after midnight, my time, I'm in Europe, so that's why I say tomorrow. Yep. Point being that on my models, headline inflation will spike towards 3%. I mean, it's not massive compared to what we see in Europe and what we see in the US, because that's, I mean, almost close to double-digit territory, right? But 3%
massive in Japan.
It's massive in Japan because you've been used to, like, let's say 0%, 0.5%, stuff like that.
Yep.
what do you make of the debate as soon as inflation turns above target? Is that something that could alter the picture?
Yeah. So I think that you're spot on with your understanding of that. Like, so CPI, if headline CPI in Japan goes from 2% to 3%, that would be much more of a global macro shock like data point than US CPI going from an 8 handle to the 10 handle. Because what's a 10 handle? Like it's already terribly high, and yeah, that's gonna move markets. But just as you said, it's generations, it's 3 decades, generations of people who are accustomed to prices do not go up. Cash is king. There's the yen has maintained purchasing power, and all that. Well, not so much anymore. And you have huge, increases in just basic cost of living because of imports of energy and food and all that. You have absolutely no wage growth to catch up with this. So you have real wages that are just plummeting, and people are pissed off for the first time. So the Bank of Japan did a survey in February of 2022, right before when dollar yen was 115, right before it took off, and they did a survey of just kind of like regular people, not within the financial universe, and they asked them, "Do you know what yield curve control is?" And and about a third of respondents said they've never heard of it before. Another third said like they're kind of familiar but not really or whatever. Well, now everyone knows what it is. So now for the first time it's become so if you have a 3% handle on CPI, that is going to I mean, you don't really even need that number printed. People are already feeling it. However, what you're going to get from the Bank of Japan is transitory.
We've heard that particular phrase before, to be very honest. But Weston, a question from my side. I'm based in Europe. We have a lot of the audience based in the US. The topic of Bank of Japan and the yield curve control, is it something that we should care about if we're not based in Japan?
Yeah, absolutely. So James Aitken was on Real Vision recently with Raoul talking about. I mean, there's a lot of guests who come on to Real Vision talking about this very topic because this is the global macro, trade right now is dollar yen. That is by the way, just so everyone knows, that is also the FOMC play because there's so much uncertainty with FOMC policy in the near term, and like front end rate vol is so high. If people want, rather than making a bet on FOMC policy, people are instead just shorting the yen against the dollar, and they're playing the policy divergence rather than the U.S. policy itself. So that's why. So dollar yen is like the macro trade right now. But the reason that yield curve control matters is because Japan is the largest net international investment position. It deploys most capital overseas. It is the largest foreign creditor to the United States in terms of as a country and all that. And BOJ's yield curve control is artificial or is indirect U.S. yield curve control. If you have yields capped at 0 or around 0 in an aging society that's cash rich and yield starved, you send that capital goes overseas and buys European like terrible credit, like high yield, negative yielding, high yield debt in Europe and stuff like that, as well as U.S. Treasuries and so on and so forth. And so that's been keeping a lid on risk-free rate for the last half decade plus, and that has allowed for a low rate environment that has therefore ripple effects across risk assets. And then when you so when you are now currently in an environment where every central bank is removing accommodative policy, BOJ is the only one left, and then they are unable to or unwilling to maintain that peg at 25 basis points, then that's when like the bottom really falls out under the fixed income market. That's when you get sovereign yields spike, credit yields to blow out, or credit spreads to blow out, and risk assets to just plummet. So that's the significance. I don't know did I miss anything? Did you do you have
No, you're perfectly right.
Okay.
One thing that I would like to add is the discussion on commodities and the link to Japan and also Germany. I lived as I like to put it, on the outskirts of Germany, just north of it in Denmark. And I feel the pain right now of being a commodity importer. I know Japan feels the exact same pain of being an energy importer right now.
Not as bad as you, not as bad as Europe,
No,
but yeah.
surely not. But
Yeah.
I mean, you come second in line basically, and point being that it hurts on the currency side when you are basically stuck in a commodity importing regime during a time of rising prices in commodities, right? And that's exactly why we see the euro being weak and the Japanese yen being weak. What's your take on this whole commodity regime and how it plays into Bank of Japan policy and maybe even fiscal policy in Japan and maybe even Europe?
On Europe, I'm gonna have to divert to you on that. For Japan, yeah. So in early June, you start to see a decoupling of 10-year U.S. nominal yields and dollar yen, which were lockstep, take for take movement, and so they kind of decorrelated. That was largely because dollar yen started to move alongside crude oil prices rather than the yield spread. So being short the yen isn't just a monetary policy divergence play. It is also like you said, a commodity. Being short commodities and having to buy at like spot market, in an ever, at ever higher prices, just to keep your basic grid running. Aussie yen, AUD JPY, that was like that's kind of my go-to. Like if you're gonna short the yen against something, you should, AUD JPY, although it did have a pullback, would probably be your best bet to do so because you have RBA who is also hiking rates, and so you have the monetary policy diversions there. Plus you got the commodity sort of upside kicker from there as well. And in terms of fiscal policy too, you are starting to see some measures from the Kishida government trying to subsidize a lot of this energy as well. But it doesn't matter if it's the government or if it's private companies. Somebody has to buy spot LNG and sell yen to do so, and then buy Aussie dollars or USD or whatever it may be. But what's going on in the European side?
Yeah, I mean, it's a big mess. If you look at the German energy policy, they've closed nuclear plants over the past 3-4 years in a row. And now they are slowly but surely reopening coal plants.
Yep.
And they are basically buying, indirectly at least, coal from Russia, even though they tell the public that they're not doing so. So I mean, you cannot make this shit up. It's not pretty. In Denmark, we are basically based on renewables, but we are a small country, so that's much easier. But the big countries within the Eurozone, they are still very, very reliant on Russia.
Yeah,
that's the sad truth.
There was a Bloomberg article out, which I just wanted your thoughts on. I'm not necessarily saying I believe it or not either way, but they were basically saying that Germany is basically calling this a Lehman moment. In terms
exactly.
of what are your thoughts? I mean, is it like it's a really kind of far out there analogy, but
well, if we assume that the current energy resource storages are intact until winter, they're basically not sufficient. So if we don't get sufficient supplies from now and until October, November, then we should basically fasten the seatbelt in Europe as a consequence of that. And it is an ongoing debate. I know German politicians are running around trying to solve this situation. But, I mean, it's the first time in like 3 or 4 decades that this is the hottest topic. And I basically assume that we will have a very tough winter as a consequence of this situation. I wanted to play a clip for you, Weston, in this regards, because earlier this week, Jiang Yang, the head of research at Variant Perception, talked about his call of this commodity supercycle unfolding. And he gave an update on this particular view. So let's have a look at this clip and get back to the commodity debate.
Again, going back to the tactical, cyclical, structural framework, I think all the stuff we talked about in terms of the structural setup for a commodity super cycle is still valid. But now it's probably tilted more towards energy specifically, where the supply response has been a lot less, and where the capital constraints are still very, very strong. So again, structurally, it's still a very favorable environment. However, again, we have an issue where cyclically, as the business cycle slows down, as the things we mentioned, right, the bullwhip effect starts to come to an end when the pull forward, the demand starts to slow down, then you don't have a full alignment anymore. So in our mind, it's structurally, because it's so good, it's still going to ultimately the trend is still going to be higher. But you probably want to focus a bit more on the specific sectors where the supply constraint is still very obviously real. So energy being the obvious one. And then within that, because the business cycle is slowing down, because there's valid concerns now about demand not being able to sustain kind of previous rate of increase, that also suggests that you're into a more kind of slower pace of gains, potentially a lot more volatile pace of gains right now. So I would say it's still very much a structural thesis, still valid. If there's market volatility and there's opportunities to buy dips into it, it's still a thesis that makes sense. But whilst the cyclical picture and some of the tactical indicators are showing that commodities are probably run up a bit too much, you kind of want to. You don't want to have necessarily the full risk allocation and the full commitment to the trade. But ultimately, I still think it's very valid. And the key insight that the supply constraint is very real.
You can watch the entire interview with Tian Yang on the Real Vision platform if you are an Essential Plus or Pro subscriber. But as you can see now, I have the lights back on in Europe here. It's very expensive to have them on. That's why I only have them on for half of the show. But enough said about that. Weston, I mean, the commodity cycle is very interesting also when it comes to the outlook for central banks. We've heard Jay Powell saying that the price at the pump is basically what he targets now, or at least he said that indirectly, right? What do you make of that commodity cycle? We've seen it kind of a slowdown in recent weeks, but is it a game changer or not?
Well, first of all, regarding that clip, I think Chan's a brilliant guy.
Yes.
And I like I've seen him on Real Vision like a few years ago. He somehow just keeps looking younger, but good for him. But he that clip, what he's talking about, it kind of reminds me of something that you were talking to Maggie Lake about, which was recently, which was that what he's saying is like, yeah, you have the structural upside for commodities, but you have to pick your spots. You have to pick your what you can't just go blindly long the Bloomberg Commodities Index basket or something like that, and you have to know you have to really get your timing correct. And so that really reminds me of when when I was watching you talking about putting on a long duration trade, as well as we were talking about putting on a long yen trade. So what are your thoughts on that? I mean, I feel like it John's got a very good point. Like right now, it isn't this blindly long sort of commodities for the inflation play. You really do have to pick and choose, like, because if you were long HG copper, you'd be destroyed right now, and so on and so forth. So what are your thoughts about how about being long treasuries? What's your call on that?
I'm tempted, Weston. That's the honest call from here. If you look at it, we have a growth cycle that is very clearly slowing. We've got new evidence of that today. We have a liquidity cycle that is very clearly slowing. Bank of Japan is the only exception, but otherwise all big central banks are pulling liquidity back from markets. And that's usually something that leads to less risk appetite and more appetite for long bonds. And then thirdly, we need the inflation cycle to turn. And if we look at inflation expectations, they have started to turn. Break-evens are back to lows that we haven't seen for quite a few months, which is something to consider. And I guess the ultimate trigger, which is something you cannot really wait for, is the final confirmation from spot inflation. If we get a couple of months in a row with declining month-on-month inflation in the US or in Europe, that is your final call to buy bonds. We don't have that yet, but I kind of suspect that it's too late to join the party if you wait for that signal. What's your take on it?
I was gonna say, like, yeah, by the time you get that print,
Yeah.
I mean, the trade's over. That's where you can make. That's where you sell, maybe, right, or exit. I mean, for me, my kind of personally, my sweet spot is so I trade mostly vol on futures, but it's weeks. So I'm not like very long term. But and I would trade against my view as well, and just stay very flexible. Ultimately, I'm just very flows driven. But yeah, I mean, I think that once you get those prints, it's over. So that's what makes it so tough, right? Is that you have to, like a day like today would have been like you would think like, okay, is this where I think like 5-year boons dropped like some sort of record or something like that in terms of a 1-day drop. And so those are days where like those are either extreme moves because of illiquidity or extreme moves because there's actual real money that's gonna get more momentum behind it, and we won't know until it's done.
I think the big surprise today is that the service sector was down so much in the PMI index.
PMI, yeah.
Yeah, because that basically means that the entire economy is down. And if the service sector is down, then the recession is near. And when the recession is near, you should buy bonds. That is at least my view. We have a couple of questions that I want to debate with you before we conclude tonight's debate. There's a question on oil. Could we go back sub 100 a barrel? Is that a feasible scenario? What do you make of that, Weston?
Yeah, of course.
Yeah.
Yeah, I mean, yeah, sure. But it's going to be because of, I'm assuming you're talking about WTI, but it doesn't really matter. But like, it's going to be because of outsized options positioning. So if you start getting close to the 100 handle, and you're going to see there's going to be a massive wall of puts, you go through that, you're going to have a dealer like a gamma flip, and you're just going to go down to mid 90s like that later that day. So certainly is which might be a buying opportunity.
Yeah, true. But if we go sub 100, it's because of the demand side, not the supply side, in my humble opinion. We have another question directed to you, Weston, in regards to the Bank of Japan that we've talked a lot about tonight. Bo asks whether, he says here, the Bank of Japan is at zero and now owns half of the GDPs issued. The rest of the world is raising interest rates and tightening the balance sheets into a slowing economy. In your opinion, which model breaks first of the two?
Which model between Japan versus everybody else?
Versus the rest, yeah. A big question.
I mean, I guess define breaks, but first of all, they could break simultaneously. One could be, Japan's not really in isolation per se. That's why people also need to be careful. But look, if Japan, like I said, if Japan lets go of its 25 basis point yield curve control by choice or by force via the RBA, who's now pretending to make by choice whatever it is. That is going to cause ripple effects of duration everywhere, and that's going to destroy risk assets everywhere. So it's not just a Japan thing. So it's not like a Japan breaks thing or something else. But I think that Japan, because you have a current account surplus, you have an unlimited printing press, and it is one of the world's not global reserve currencies, but it is a major FX pair. They can basically just keep doing this and keep acquiring JGBs. Like, what's the difference between owning 6% of outstanding issuance, 70% of outstanding issuance versus now? They can do that until Kuroda's term's over. But at that point, they're going to have to start to signal or potentially not signal at all and change policy. So I don't think that this current structure will break because of the fact that you have the finish line for Kuroda soon.
I like Bo's view. I think the Bank of Japan will break at some point. They will at least increase this target for the 10-year yield curve control. That's my view. Or at least I like to bet on it.
Well, so I would agree. So again, depending on how you define break, but like they said in 2013, 2 years, 2%. So it's been it's been like 4 times longer, and you know, nowhere near like that until recently. So you could say that it already failed, you know, like many years ago. So it already broke and failed. Yeah. So.
Exactly, Weston. So let's conclude on tonight's discussion. The Bank of Japan is under fierce pressure. It will be very interesting over the next couple of weeks whether they can actually control this yield curve, given the amount of pressure that they are faced with by big international institutions. We have compelling evidence from the Eurozone that the service sector is also under immense pressure, which leads a recession closer. As far as I'm concerned, and also that could be a signal that interest rates are going down in the long end of the yield curve. Weston, thank you very much for joining the show. It was a pleasure to talk to you tonight.
Pleasure's all mine. Thank you so much. This was fun. We should do this again sometime.
Yeah, we should definitely do it again. Everyone out there, thanks for watching the Real Vision Daily Briefing. We will be back tomorrow. My colleague Maggie Lake will interview Jim Bianco on the developments again tomorrow. And I think it will be another interesting day in markets. Thanks for watching.